Good morning, everyone. Welcome to the Federal Home Loan Bank's Collateral Question and Answer session. Today, we're just here to answer your questions, right? So we're hoping that you'll submit some to us through the Q&A function or the chat. My name is Elaine Shoemaker, and I've been with the bank forever. Came in actually through the wire transfer department and moved into the safekeeping function. And then in 2008, when the safekeeping function and collateral operations merged into financial services, I became the manager of that area. So anytime that you submit a QCD form or pledge or release securities, that goes through our folks on our side of the house. So we're here to help any questions you might have. I would like to introduce everyone to Deidre Duran-Gray. Deidre took Kylie Mergen's position about 7 months ago, so she's relatively new to our area, but not to the bank. Deidre, you want to tell them a little bit about yourself?
Yeah, so as Elaine said, I work alongside her. I joined the bank in 2010 after I had enough as an examiner during the financial crisis. Started as a senior member credit risk analyst, which means I just oversee all the membership and deterioration, financial things of that nature. And then in 2017, I decided to leave credit and go to the legal department and help build out the compliance program at Federal Home Loan Bank. And as Elaine said, I joined about 7 months ago. I had this wonderful opportunity to come back to credit, and here we go. So I oversee, along with Elaine, the collateral verification and review process. So.
We welcome you. So today we're going to do something a little different. We're going to shake things up a little bit. We've got some others sitting in the room with us today, the system matter experts. Heather Fonensteel is from the operations side, so welcome, Heather. We have Tim Royer and Amber Husk from the collateral review side. So we're going to do just a panel discussion. We'll answer your questions. We'll go around. So, well, Heather, you want to give a little background about how long you've been here at the bank?
Good morning, everyone. My name is Heather, and I've been at Federal Home Loan Bank for nearly 16 years. Kind of similar to Deidre, I've floated around the bank in different capacities and landed back in financial services as the coordinator for a little over a year. So, yeah, been here a long time, too.
Yeah, Yep. Tim?
I have been with the bank just over 7 years. I was a road guy doing collateral reviews, seeing all the members, and then recently have taken on a new role as a collateral review officer that's primarily in the bank. Before that, I was 30 years in community banks doing commercial lending, consumer lending, internal auditing, all kinds of stuff. So
Excellent. Amber.
Yes, good morning. I'm Amber, and I've been with the bank for almost 15 years. I started out as a road gal and did some collateral verifications for 9 years, I think it was, and then moved into the collateral review coordinator spot, I think in 2017, so been there for a little bit.
Excellent. So hopefully this is going to be fun and very helpful for you guys. So please, again, submit your questions through the Q&A or through the chat function. Hopefully everybody can use that today. I think we've had some issues with that earlier this week. So I'm going to start off with a question that we received prior to the webinar. We appreciate the question, Virginia. What signatures? This seems to be a pretty hot topic, and it's on everybody's mind. Outside of real estate loans, we have started using electronic signatures on some loans. This is a great convenience for our customers that can't make it into the bank or live outside of our community. We strive to offer the best customer service we can, and the DocuSign feature allows our bank to step into the 21st century, which many of our customers prefer. In saying all of this, who at FHLB sets the policy for wet signatures? Is it your board of directors, or does the decision go higher than that? We would like to plead the case for allowing electronic signatures on loans used for collateral outside of our single-family real estate loans. So,
All right, well, I guess I'll start with that one. Unfortunately, it does go beyond our board of directors. Actually comes down to the legalities. The law has not kept up with technology, unfortunately. And we completely understand that this is convenience, and it is a little confusing in the period of time where we do have this technology available. So I completely understand your standpoint. But however, it doesn't preclude you from actually doing this as a business practice. You just can't pledge those loans to us. So if that is a convenience to your customers and this is something you would like to use, you can use that as a strategy of your bank. You just can't pledge those loans. So, and I've said this during some of the other webinars. When we are allowed to take e-signatures, you will be notified, I promise you. That will probably be one of the biggest things we will shout out to everyone that we can do. We can take e-notes. That is something we have available to us, and we do have members pledging that. So if you would ever like to discuss e-notes, I'm more than happy. You can get in contact with Deidre, and we can go over that.
right.
But unfortunately, at this time, it goes beyond our board.
Right. And the e-notes are just for the single-family
Yes.
real asset category today. And really it boils down to being able to, we have to be able to liquidate the collateral in due course. If we should ever have to take possession of that collateral, we would have to be able to go out on the market and sell that. Well, you can't, because there's no proof that that's the original signature.
Yeah.
Right? So there's no market for it. The laws haven't kept up. So unfortunately, that's what drives our decisions.
Yes.
I would point out, though, a year ago, because of the proliferation of e-signed documents, our board did allow us to accept copies of signatures and e-signed signatures on modifications, extensions,
Yes.
as long as there is a wet signature promissory note to refer back to.
Yes.
If for some reason that would be amended and restated, then it would no longer work. However, for the modifications, extensions, it should work fine. So that is as much as our board can do at this point.
Right. Okay. Virginia, thank you very much for the question. We have one that came in. Will there be any other changes to the schedule of eligible collateral other than the lending values? So, yes. There's just been a couple minor tweaks, not really to the underwriting guidelines per se, other than LIBOR indexed loans, okay? So everybody should be aware that the cessation of LIBOR is June 30th, 2023. It's been a hot topic for a long time. So, you know, the 1 week and 2 month tenors have been discontinued several months ago, so those have not been eligible. They're not eligible if it's LIBOR linked and the note date was after December 31 of 2021. Effective June 30th, effective July 1,
Yeah.
LIBOR is gone. So, the Congress enacted the LIBOR Act last year. LIBOR Act really should cover just about every scenario where there's not sufficient fallback language that it would convert the loan over to a SOFR rate, okay? Today we know that we asked you to break out your LIBOR-linked loans on the QCD form. Mm-hmm. Our expectation, because you will still have, because this QCD form that opens up on Monday and the 6/30 QCD form, you'll still have LIBOR-linked loans, so we're still asking you to break those out. Our expectation when you file your 9/30 QCD form, if SOFR can't be your default rate or there's something in the contract that says it's not eligible for the LIBOR Act, that loan is either, if it doesn't qualify for the LIBOR Act, then it becomes ineligible. If it falls under the LIBOR Act, then it's already converted to a different reference rate. So we will no longer have any LIBOR-linked assets that are pledged. Everything is either converted or ineligible, okay? So that's probably the biggest other change. We had the one on the loan listing.
Yes, we also had a change in regards to collateral loan listing. It actually, I think the big change happened in the latter part of 2022, where we can require a collateral loan listing if your non-performing assets start trending up. So for banks and thrifts, if the non-performing assets to Tier 1 and loan loss reserve is greater than 75%, you would be required to provide a collateral loan listing. For credit unions, it's non-performing assets to net worth and plus loan loss reserve greater than 55%. So that is another change. I think we tweaked the definition maybe this round with this last board meeting, but the bigger change happened at the end of 2022. But with that said, I mean, we do review that on a typically on a quarterly basis. So if there are significant changes to the schedule of collateral eligibility, you will be notified. I mean, we try to do a pretty good job with our marketing and communications to get that information out to you. So hopefully you would be in the know if something happened.
Excellent. Okay. So real quick, the lending value changes, just so everybody knows when they go into effect. Okay, so if you have securities or you actually have delivered loans that are sitting in our vault, the lending values go into effect on Monday. Okay, for all of those blanket pledge members that are pledging via the QCD form, the lending value changes will not go into effect until you submit your 6/30 QCD form. So you've got a little bit of a reprieve. If you've not been in some of our other webinars this week, the single-family loans are dropping down to 77%. Yeah. But then the ag went up. Overall, it's still a 3% reduction, or just about a 3% reduction in our total lending value over all of our membership. But so, all right. Hey, we've got some good questions coming in. We have a loan with a construction mortgage, but construction phase is completed. The business is open and has a certificate of occupancy. Would this loan now be considered eligible under the commercial real estate category? Who wants to take that one? Amber?
Sure. Yes, the business, since it's open and you have proof that the construction phase is complete, we would look at that as enough proof to say that, oh yes, this is now a commercial real estate property, not construction, and should be eligible in the commercial real estate category as long as it meets those underwriting requirements in that category. So I would just revisit those before pledging it there, and just to make sure that it does qualify, and good to go.
Bobby, thank you very much for the question. All right, we have another one. Non-owner occupied 1 to 4 family residential properties, rentals, are to be pledged as commercial real estate, lending value 65%, or 1 to 4 family, new lending value 77% as of our June call report. Question? Who wants that? Tim?
Well, since we're a collateral-based lender, we refer to specifically the collateral for the pledging category. These are 1 to 4 rentals, and so they should be pledged in the 1 to 4 category, whether they're owner-occupied or not owner-occupied. So they will begin on the QCD receiving value at 77% on July 1st.
Or whenever they file their call report, yeah.
When they file that.
Right. Okay. Matthew, thank you very much for that question. Here's one. How do I amend my QCD form? Heather, you want to take that one?
Sure. You have the ability to amend your QCD form at any time, whether it's an open reporting cycle or after the QCD is completed. You would just log in to members only and click on the link for update or for the QCD form. There's a link that you would click on, and you would make the adjustments to whichever line item you were needing to. The only caveat is that you would still continue to report collateral that would have been booked as of that quarter end. For example, we're still in the 12/31 QCD reporting, and you would look for any of your assets that were booked as of 12/31.
Can I ask a question?
Sure.
So when you open up the form, is it available for data entry, or is there something you have to do to open it up for data entry, if they're amending it?
Yes, there is in the upper left-hand corner an amend button that you would click on, which then opens the form up for you to be able to edit. Otherwise, it is in a read-only format. So you would still go through the process of your QCD preparer to complete the form, and then you would submit it to your QCD approver for completion. So that step would still be exactly the same as if it was a brand new entry.
Do we have anything else? Do you have to have an updated appraisal to determine the loan to value? Okay, Amber, it's yours.
You do not have to have an updated appraisal to determine loan to value. Typically, what we see on the road is that when a loan is originated, there's an appraisal done, shortly before or around the time of the origination date. That appraisal stays good until the life of the loan. You are, well, as long as the lending value or loan to value is good, we would accept that original appraisal throughout the life of the loan. You are more than welcome to get an updated appraisal at any point during the loan. We don't tell you not to do that. But if let's say if the value of the property decreased by quite a bit, you got to pay attention to that loan to value based on the updated appraisal. So
But can I ask you a question?
Yeah.
So if they get an updated appraisal, do they have to use it
Yes.
So they have to update their loan to value if they get an updated appraisal,
Yes.
no matter whether it was good or bad?
Right.
Perfect.
We would take the most recent value. Yes.
Excellent. All right.
I would add the caveat that appraisal, regardless of what age it is, needs to fairly represent the collateral that is actually taken. I've seen many times on the road where, say it's ag ground, and some of the ag ground has been released. That appraisal obviously no longer reflects the entire value, or it overstates it. So there has to be some kind of adjustment, updating to that, so that the appraisal fairly represents what's left or what has changed.
Well, that makes sense. Do you run into that very often?
Some,
Some?
yeah,
Not a frequent thing, though.
no.
Okay.
But sometimes we find that they go ahead and put that in a loan write-up, or they have an updated appraisal or what have you, where we can see what it was prior, we can see the valuation of the land that's been released, we can determine, or they've already predetermined the value remaining, and we can go on from there. They're using that former appraisal as support. But in a lot of cases, they have a dated appraisal, they've released some ground, the ground that's remaining because of the appreciation has gone up so much that they go ahead and they do some kind of update on their own, generally. So we just needed to fairly represent what's out there.
Nice. Okay. Makes sense. All right. Looks like we have another one that came in. I email a copy of an home state valuation that we used on some of our wonderful family loans. wanted to know if this was acceptable in place of the appraisal. Okay,
So
Deidre?
Carol, I think I asked you for a copy of it and you sent it to me the other day. I have not had a chance to go through it completely yet. However, what I would say in all cases with appraisals is just to make sure that you're following your regulatory requirement on that. So I will be taking a look at that and get you an answer back, I promise.
Okay, well, thank you, Carol. I do not have a hard copy button on the QCD form on the website. How can I access it? Gosh, Vicki, when you go log into members only, go to the QCD form page, there should be a hard copy button right below the link to the online version. If there's not, then we have an issue. So we will certainly follow up with that once we get out of the webinar this morning. So be happy to follow up with you there. All right. Another question. Real estate mortgages with future advance clauses securing multiple loans. We generally cross-collateralize subsequent loans to our existing mortgages. If we made a loan for a hotel and then a few years later make a loan for a PIP, the first loan can be pledged but not the second loan, assuming combined loan-to-value is conforming. We're pondering that, Matthew. Tim, any?
Well, so I'm a little lost in the question. My apologies for not being able to track it completely. So essentially, if you're in first lien position and you are securing a loan with collateral that's already established through a future advance clause, and the total value of that mortgage supports that second loan, you should be fine. Shouldn't be any problems. However, if you're like stacking mortgages together to support one value, it's really going to have to be kind of drawn out on site to make sure that you are encompassing all of the loans that are against all of the collateral. And so we would need to be able to do that. But we're at 85% LTV first lien position. If we can establish that, then you're going to be okay.
Good question, Matthew. All right. Let's see. Here's one. Are any other commercial operating loans eligible for CFIs to pledge that are not for equipment, crops, or livestock? So, for example, a loan to purchase a business. Amber?
Yeah, so unfortunately, a loan to purchase a business does not fall into our operating loan category. For operating loans, the only collateral that we can accept is equipment, crops, and livestock. Well, not even if it's a revolving line of credit, we cannot accept equipment, sorry. We have an equipment category, so that equipment falls into the equipment category. Crops and livestock are in the operating category. And Tim pointed out that equipment loans in the equipment category have to be amortizing loans. They can't be a revolving line of credit.
So the only time we accept a revolving line of credit is like in our HELOCs, and that's single-family stuff, right? No?
No, we accept revolving lines of credit in the operating category as well, but the collateral has to be crop and or livestock.
Gotcha. All right. If carryover debt is refinanced into a fully secured real estate loan, is it immediately eligible for pledging?
Yes. We're not purpose-driven on the ag real estate.
Okay. All right. Can I pledge a loan with a swap agreement? Well, that's good. That comes up regularly.
That does seem to come up quite a bit, and I guess the answer to that would probably be it would depend. I think it would depend on the agreement. I haven't seen all that's out there, but the few that I have encountered, the language in there is pretty clear that we are no longer in first position. You as the member are no longer in first position. So if that is the situation when you're reading that agreement, then no, we cannot take that as collateral. Now, there are other agreements. There's ISTA agreements, which is my understanding that it's a little bit different, and we can take those. But again, we really need to pay attention to what the language says in the agreements themselves. I don't know who the vendors are, but I think I've heard there are certain vendors that deal with the swap agreement. So just pay attention to those agreements. Tim, do you know of any of the names offhand or?
I don't, and
Okay, I
I
couldn't
don't know
either.
that it'd be appropriate anyway.
Well, I just didn't know if they,
Right.
if they recognize any of them in their own.
The biggest issue is if they are sharing the same collateral as the loan share, as what's on the loan, then we would no longer be in an unencumbered first lien position. So everybody would be in a same shared, and we can't accept loans where we're not in an unencumbered first lien position.
Yeah.
Oh, Matthew, another good question. Why can't USDA, FSA, or SBA guaranteeing loans be pledged? Well, I can answer that one.
Okay.
We did a lot of research on that, working through that, because we cannot, if we had to take possession of the loan, we cannot do that. The USDA will not allow us to do that. Therefore, we can't take any USDA guaranteed loans. We just can't perfect our interest in that if we had to. And by regulatory requirements, we have to be able to prove that we can do it.
Mm-hmm.
So unfortunately, because I know that those are good loans, we just can't do it. So we spent a lot of time researching. Actually, we started out as researching, I think, the SBA guarantees.
Yep.
Which led into this whole big rabbit hole that we went, oh shoot, this isn't going to work. And yeah, we got a lot of intelligent folks involved in that research project, and it's like, well, we have to carry that across multiple loan or asset categories. So unfortunately.
And just to add, Elaine, when you guys open up your 331 QCD form beginning on Monday, you will see we have removed the government guaranteed section completely from the form. It isn't even an option for you to report going forward.
Right. We had a few FSA loans on the books that were grandfathered in, but those are almost all gone now as well. So. Anyway, yeah, that was a bad deal. That was kind of an eye-opening rabbit hole we had to go down. So unfortunately, gosh. Oh, here's one. How often do you need to calculate the DSCR? Do you have to recalculate that regularly?
No, you don't. We require that we look at the most recent DSCR calculation. That could be at origination, but it also could be the one that you recently did with an annual review. So we will take whatever the most recent is, which also gets back to you have to verify it. You have to make sure eligibility still works, because if it previously was above 1-to-1 and has dipped below 1-to-1, then it would no longer be eligible until such time as another DSCR calculation occurs.
Great. I know a question that has come up several times on the operations side. Securities. If they have, so if a member has reviewed the eligibility guidelines for securities and still aren't sure whether it's eligible or not, what do they need to do?
For securities?
Yes.
Is that what you're referring to, Lee? One thing that we encourage is if you ever have any doubt as to whether or not a security or loan for that matter would be eligible collateral. Let's just go with securities specifically. We are happy to review the QSIP or the security for eligibility before pledging or sending in a collateral activity report to pledge that asset. And we will then provide you feedback after our screening, what type of market value it may have against the lending value percentage, and in the event that you had, let's say, for example, a muni that you're looking to potentially pledge, that would require further review.
Absolutely.
And we would also extend if there's any fees associated with the additional reviews required.
Right. The muni bonds are considered case-by-case collateral, so anytime anytime anybody wants to pledge one of those, there is a $125 case-by-case review fee at the QSIP level. So if this muni bond is it refunds,
Several.
Yeah, it's all of the QSIPs underlying that were pre-refunded have to be reviewed for eligibility. So it's $125 per QSIP. So you might do a little scrubbing on your end before you submit. You know, obviously we would come back to you and say, hey, you know, this has like 10 underlying QSIPs. Do you really want to pay $125 per QSIP? So, because we do a full research, we do a write-up on all of the eligibility criteria. So I think we run into that on the operations side quite a bit.
Yeah, we do.
Yeah, okay. Oh, here's a good one. What is a phase one? And can you give me examples of what would require a phase one? Does it have to be a clean phase one?
I'll take this one. So a phase one is a environmental check of the property in question. It does have to be, we do have to see a clean phase one in file for the loan to be eligible, or if there are recommendations to remediate an environmental concern, then we need to see that the recommendations were met in the file. Examples of what would require a phase one would be gas stations, dry cleaners, auto repair shops that do oil changes, car dealerships that do auto repairs with the oil change. And do you have any more to add to that, Tim?
Any place that's going to deal openly with chemicals or transfers of chemicals, those kinds of things. Machine shops.
How about an ag co-op? An old building?
A co-op would definitely need to have one.
Okay.
Because it's commercial, we don't require any phase ones on ag ground. So, but the co-op itself being a commercial property would require it.
And we had a question earlier in the week about, so Tim does oil changes for his friends at his home or out of his garage. Very different than a commercial business?
Well, the first thing is the home's going to be, follow our eligibility guidelines for 1 to 4 family, and phase ones are not part of the eligibility requirements.
Mm-hmm.
So we're not going to even look for that.
Okay.
If it falls into a commercial business and oil changes are part of the process, whether it be like for fleets or it be an oil change business for consumers, those are going to require it.
Mm-hmm.
Can you use an old phase one? Or how old's old? Like if you have one that's 20 years old, and can you use something like that?
Is the loan 20 years old?
That's what I mean. If you have a new loan, can you rely on that?
No, unfortunately not.
Good.
I think people have asked that, so.
Yeah, good question. Oh, okay. For ag operations with highly volatile commodity cycles, is only the most recent calendar year tax return DSCR calculation considered? Or if our analysis uses a rolling 3-year DSCR calculation, can we still pledge ag real estate loans if only the 2021 DSCR is less than 1, but the 3-year average is above 1?
We're going to look at the most recent annual DSCR. So the 3-year average is, eligibility requires that it be the most current information, so averaging it doesn't provide the most current. So the previous 12 months is what we would rely on.
Well, we appreciate the questions. Keep them coming. Here's another one about the wet signatures on all documents. Do we have to have a wet signature on all documents, is how the question has been posed.
Deidre?
Amber?
Either one.
It doesn't matter. You do not have to have a wet signature on all documents. I know when I first started, we required wet signatures on a note and anything pertaining to the note, like a change in terms, modification, a launch, any of those things. We also required the wet signature to be on the deed of trust and mortgage, but that is no longer the case. The only document that has to have a wet signature as of today is the promissory note.
That's, of course, it's an e-note.
Yes. It's an actual true e-note.
True e-note. And we have, we've had a couple of members pledging e-notes, so we're hoping that picks up, that business. There's a lot of research and energy that went into that, just being able to perfect our interest and make sure that we were in sync with our regulatory folks. So I know, and it's a very hot topic. Everybody talks about it. So unfortunately, until the laws change, we're kind of stuck. And the markets change.
Wet signature it is.
Wet signature it is. Oh, here's a good one. I think, Deidre, this one's for you. How do I amend my subordination agreement?
Oh, I've had a lot of those questions in recent days.
Oh.
The answer is you would reach out. I mean, if you're going to do a new subordination agreement or an amendment, you would reach out to your Federal Home Loan, or for the Federal Reserve Bank contact. And if you don't have your Federal Reserve Bank contact, you can reach out to me. I'm in frequent contact with that individual, and we'll pass the information along, or I'll get you in contact with them. But you would really start with the Federal Reserve Bank initially to get that started, that process, and then we'll go from there.
Excellent, excellent. Yes, with the recent market events over the last, it's been 3 weeks now? Oh, gosh.
3 weeks.
It's been a crazy 3 weeks. A lot of collateral movement,
Yes, we have.
a lot of collateral pledging to the Fed for their new program. It was kind of a rough start because I don't know that the operations folks at the Fed were quite prepared for this new offering that came out. So it took us a little bit to work out the kinks with them, but I think that after that first few days, once we got the process, they got their process straightened out. It wasn't really us, it was just them trying to figure out how they were trying to accommodate for the new Fed program, how to accommodate the pledging of that.
But I think, Elaine, that the new Fed offering has sparked a lot of conversation with our members just internally of how can they increase their capacity with us.
Oh, absolutely.
With the recent events that have occurred in the marketplace. And, there's always somewhat of a fear of a run on deposits and just to, be prepared in case something else happens. So we appreciate those calls, and we're here and happy to walk through any borrowing or increase of capacity.
Right. Yeah. We have definitely seen an uptick in collateral pledging. I think, when I prepared our presentation earlier in the month, what were we sitting at? About $118 billion in total collateral pledged. As of Wednesday, that value, we were up to $122 billion in collateral that's been pledged to us. I think, supporting outstanding credit obligations of maybe 55 billion, right about there. So I know it's been a very hot topic, and, you know, we're here for you guys.
Yep.
So,
Can't
yeah.
stress that enough.
Absolutely. I mean, we're here to help you to be successful.
So along those lines, if they want to amend their QCD and it's the interim period between when the quarter ends and when they file their new QCD, can they do that?
Yes.
How do they do that?
Well, they can amend their QCD form using collateral or loans that were booked as of that quarter end.
And they can do it on the website?
Well, no. So I think the question was, so Monday, the 12/31 QCD is no longer available to you to amend. And if you haven't amended it, your 12/31, but you're not ready to file your 3/31 QCD form, you can print of your QCD form or submit that to us via email. We can go in and amend it from the backside, as long as you have not started or submitted your 3/31 QCD form. We can do that for you, but you cannot access a prior period QCD form, okay? So once Monday rolls around, you will no longer be able to amend your 3/31 QCD form on members only. 12/30.
The previous period
The
QCD.
previous,
Previous period.
yeah,
Sorry.
that's okay.
Thank you.
But
We had a lot of-
that does also lead to another good point, is in the event, let's say you're going through a collateral verification and you're using 12/31 information and need to make an amendment to that 12/31, but you've already completed your 3/31 QCD form, you would have to submit a hard copy form to us for our file.
Right.
Same procedure.
Right. It's the same procedure, but then at that point, we are unable to amend that 12/31 QCD form because your current quarter end has already been submitted, and we can't go back and make any adjustments at
Right.
that point.
Right. And just make sure that the 3/31 was updated appropriately
Yes.
for that change. Right. Good
Good
point.
question.
Good, yeah, good point, good question. All right. Is any other form of environmental due diligence accepted besides ESA Phase 1?
At this time, no. At a minimum, we require a phase 1.
A clean Phase 1.
Yeah.
I know, we talked about that.
Elaine has to keep reminding me, I'm like, clean phase 1, yes, so there's a
Well, you
clean
know,
emphasis there.
Just because we have a Phase 1 doesn't always mean
That
it's
is
clean.
true, clean.
So, yes, it has to be a clean Phase 1 before you can report it as eligible collateral.
Property can't be glowing or something of that nature.
What? You know,
Clean.
clean Phase 1. Okay.
This question came in after.
Are wet signatures required on modification agreements?
So, not anymore. They used to be, and that's been a recent change, I think, in the last year.
I think it changed March of last
Yeah,
year
yeah.
when it became effective.
So that is fairly new. But yes, modifications can either be e-signed or a copy of a wet signature. If you're delivering in loans, then we would take a copy of a modification now. But it did recently change.
And they have to meet the other requirements within the,
URETA or e-sign
Yeah.
Act, those, yeah, we have to see that stuff.
Oh, do you? Okay.
What is e-signed?
Is e-signed? Okay. So what are some of the other issues that you run into when you were out on the road, Tim? Or as you're reviewing those, so Tim's primary job now is reviewing delivered loan activity that comes into the bank. But what are some of the other issues that you encounter?
So one of the things that routinely happens with operating loans is generally a structure such as our community banks will collect a financial statement from a borrower in, say, December, January, February, that lists crops and livestock on hand that can be pledged for their operating lines. And that's at a given level. They have generally an operating line that, when it's up and running, may exceed that. And it may be fully advanced through the spring, and so by June, it's at a 100% max. And then the issue that we have is when we're out there reviewing in the early fall or what have you, and we're looking at the June 30 max number, it's no longer supported by the January, February crops and livestock on hand. And so that whole operating cycle, that is something that we see over and over again. And so one of the things that's not necessarily said is that it's crops and livestock, but if we can have demonstrations that the advances on the line were for inputs for that crop cycle, we'll accept those inputs. We have to figure out what those are if we're going to use that to support that line. So that's one of the things that I always try to encourage. Sometimes those things happen automatically. The producer's been a longtime customer, so they write checks out of their operating account, and the money is automatically advanced through a transfer that covers those kinds of things, and so sometimes it's difficult. I would just caution everybody who pledges operating lines of credit that exceed the established balance. However we're going to look at that those lines may be ineligible if they don't have the support. So that's one thing.
Mm-hmm. Yeah, for sure. Heather, are there anything on the operations side that are, questions that keep coming up to the surface? And we've had a lot of eligibility questions the last few weeks.
Yeah, I think if anything, we've seen an uptick in security pledging.
Oh, yeah.
And we've had a lot of interest in, what type of lending value would be given to some of the agency pieces as well as CMBS, CLMBS. We've had a lot of interest in the muni market as well. So we've been keeping our analysts hopping with a lot of reviews. So I think we've seen a huge uptick in security pledging.
Mm-hmm.
There's been a lot of interest.
Yes, I would totally agree with that. We've been really busy. I had a question, and it just escaped me. Doggone it. If a member submits a hard copy form, just because they aren't really a hard copy form of the QCD, just because that's the way they've always done it, is there any training available, or what would they need to do if they really wanted to submit their QCD using the online form? Are there help functions somewhere, or?
Oh, absolutely. It's so much easier to complete your QCD form online versus the hard copy form. We have built-in help functions within the form itself, so it's like a little hover that will explain the underwriting requirements of that particular category that you're reporting on. It also does the calculation for you.
Mm-hmm.
So you're just putting in the number of loans, UPB of, let's say, 1 to 4 family, and then it calculates what that lending value would be based on the current lending value percentage, rather than you having to recalculate the totals
Manually.
And then, once you complete the form and then approve it, I want to say instantaneously, but I mean, let's say 15 minutes is
Right.
pretty real time.
Yeah.
Will update your capacity to borrow. So we've worked really hard to streamline the process so you have that money available to you in a very quick turnaround time.
Collateral capacity,
Yeah.
Yes. So they can submit or update the QCD form this morning, and within probably 30 minutes, come in and to the lending desk and borrow against that collateral.
Yep.
So, very good. Oh, looks like we have another question that just came in. Oh, it's about a phase one. How old can a phase one be in order to be considered valid for a commercial property? Well, if the phase one would be at the time of the loan,
Yeah, typically, if it's a purchase, and not a refinance of that loan, then we need to see a phase one that is around the origination date of that purchase. If it's a recent refinance, we don't really have a time limit. So I guess if you have a specific time that you're wondering about, I would say to email us and ask us, and we can discuss it as a group and then also elevate it if that needs to be elevated. If you have a specific question on one, that would probably be your best avenue to go. We don't have a time limit, a set time limit, so I would hate to just throw a number out there right now, but
nothing hard and fast.
yeah.
I don't know that I see any more questions coming in. Are the opportunities, we've got some opportunities coming up. Our annual management conference is just right around the corner, about 2.5, 3 weeks from now. It's in Overland Park again. Very well-attended conference that we get a lot of positive comments, a lot of positive feedback on this. So we highly encourage everyone to attend. We also have some regional meetings later on in the fall that in each of our 4-state areas. More information will be forthcoming as we get a little closer to those dates, but you can look forward to those. Collateral review officers, if you ever have any eligibility questions, please reach out. They're great to work with. They'll be happy to answer any questions that you might have, any operational questions that you might have, or security eligibility. Feel free to reach out to the ops side. We're all happy to help answer any questions you might have. We're here for you. We appreciate you guys immensely. Again, our contact information.
Well, I was going to mention one thing on here. I was asked this week about the AMC, like how to register, and that is on our website. And we also have an agenda out there. So if you are looking at who is this applicable to, go through that agenda and see in your, bank or institution who might benefit from going. And also on some of the regional or the regional meetings, I think only maybe the Littleton, Colorado one might be out there. I think the other ones, there's no registration date for those yet. So just wanted to throw that out there.
Oh, hey, do we think we have time to address this last question we have come in?
Oh.
Are loans secured by titled commercial vehicles eligible, such as semi-tractors?
So we get that question a fair amount, and what we are going to determine is if it works as equipment, some kind of revenue generation, then we're going to take that as collateral. However, if it's a farm work truck, we're going to be okay with that if it's the farm work truck. Mm-hmm. If it's the farmers go to town truck, that's not going to work. So in this case, semi-tractor in whatever capacity that is, that's gonna be used for revenue generation. So it would be eligible in the equipment category.
Okay, very good, very good. Well, I think this really pretty much wraps up our webinar for this morning. Boy, I'm ahead of myself. We appreciate all of you taking time out of your busy days to join us. We appreciate all of the great questions. There is a survey that we ask you to complete as you exit out of the webinar today. We really appreciate your feedback. We look at every one of those comments. We value your input, so please take a minute to fill that out for us. If you have any questions, here's our contact information. Please feel free to reach out. You guys are awesome. We appreciate you immensely. I think everyone here, yeah, it's a great place, and we're here for our members. So enjoy the rest of your Friday. Have a great weekend, everyone, and we will talk to you all soon.
All right.
Thank you.
Thank you.